Howdy, folks. Welcome to Liberty Call. Today is Thursday, June 1st, 2023. Hope everybody's having a fantastic day out there. You can see my boy Jake back here. He is ready to go. It was raining a little while ago, and there's black clouds all to the north of us over here. But the sun has come back out. So I think we're going to go out and play some ball. Want to play some ball, Jake? About cookie. Oh, he likes that word. Hi, Jake. Anyways, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. We're going to talk about the news of the day. I got a funny thing we're going to show in just a second. But first, if it's your first time watching, please give me some thumbs up. Hit the subscribe buttons, the follow buttons, all that good stuff. And let's go ahead and jump into the funniest thing I have seen today. All right. Here's President Joe Brandon here at the Air Force Academy, about 20 minutes south of me. And I guess it's not raining there when this was filmed, but watch this. Here we go. He handed off the diploma and whoa, there he goes. There he goes. Oh, no. Oh, no. He probably broke a hip or something. Isn't that terrible? That is the leader of the free world. Wow. Very impressive. Very impressive, Joe. All right. All right. Let me get that off the screen. Little humor. Never hurts. All righty. Let's go ahead and jump into the numbers for today and see how they turned out. The Dow Jones, lots of green on the screen. The Dow Jones was up 0.47%, 153 points, closed at 33,061. S&P 500 was up 0.99%, closed at 4221. NASDAQ was up 1.28%, closed at 13,100. The VIX fell 12.6% today. It's down to 1568. Canada was up 0.51%. Brazil was up 2.17%. And Mexico was flat at down 0.04%. Over in Europe, Germany was up 1.21%. The UK was up 0.59%. France was up 0.55%. The Netherlands was up 1% even. Spain up 1.3%. Italy up 2.01%. Switzerland up 0.7%. And Portugal up 1.27%. In Russia, the MOEX was up 0.15%. The RTSI was up 0.61%. And the overnights in Asia, a little more mixed. The Nikkei in Japan was up 0.84%. Australia was up 0.27%. New Zealand was up 1.2%. In China, the Shanghai was flat at down 0.01%. The Shenzhen Component up 0.39%. China A50 up 0.42%. DJ Shanghai flat down 0.02%. Hang Seng down 0.1%, and the Taiwan weighted down 0.66% for the day. So yeah, most of little mixed in Asia overnight, but everything in the European markets and then here domestically looked really good. I mean, other than Mexico, Mexico was flat, but everything else was up. So I mean, I guess the debt deal, everyone's getting excited and getting feeling good about the markets again, but tomorrow's a new day. All righty. Well, let's go ahead and go through today's market recap. S&P 500 rides, debt ceiling progress higher, tech resumes its climb. The S&P 500 advanced on Thursday as the U.S. moved closer to avoiding a default after the House of Representatives passed a debt ceiling bill, the Fiscal Responsibility Act, I find that funny, which aims to raise the debt limit and reduce government spending, was approved on Wednesday, setting the stage for the Senate to vote on a measure before it reaches President Brandon's desk for signing into law. The prospect of lawmakers passing the legislation ahead of the June 5th deadline when the U.S. could run out of money boosted market sentiment. Again, they're not running out of money. They're just going to print more. Irritating. Energy stocks experienced a notable rebound with oil prices surging over 3% ahead of the upcoming OPEC Plus meeting. Major oil producers are expecting to maintain current production levels, which lifted energy sector sentiment. Companies like Halliburton, Baker Hughes, and Schlumberger drove the gains in the energy sector, with Schlumberger's stock rising over 6% following its positive revenue forecast for 2025. The technology sector also performed well, with Meta Platforms and Apple leading the way. Apple's upcoming developer conference, scheduled to start on Monday, contributed to positive investor sentiment as the company is anticipated to discuss further integration and monetization of artificial intelligence technology. Salesforce, on the other hand, saw its stock decline by 4% despite reporting quarterly results that surpassed expectations. Concerns about waning demand and Salesforce's ability to meet future guidance impacted investor sentiment. Having used Salesforce briefly for a short period of time with one of the brokers I was working with more than a decade ago, Salesforce sucks. It's terrible. It's one of the worst CRMs I've ever seen in my life. I mean, and I've worked for a lot of companies through the years where you had to document data, information into client accounts and things like that. But yeah, it is just awful. It's clunky, cumbersome. I'm not a fan. All right. In terms of earnings, Macy's shares initially fell, but later recovered to trade up 2% despite cutting its full year outlook due to lower than expected quarterly revenue. Margins were impacted by the increased promotional activity. Nordstrom, however, surprised investors by reporting a quarterly profit, leading to a more than 5% increase in its stock price. On the economic front, labor market data continued to show strength, with initial jobless claims rising but coming in lower than expected, and new jobs in the private sector for May exceeding estimates. The positive labor market indicators were released ahead of the highly anticipated non-farm payrolls report scheduled for tomorrow, which is expected to show approximately 180,000 jobs created in the U.S. last month. Overall, the market was buoyed by the progress in the debt ceiling bill, positive developments in energy and technology sectors, and encouraging labor market data. Investors remained cautiously optimistic as they waited for non-farm payrolls report for further insights into the health of the U.S. economy. Again, I just have this sick feeling in the pit of my stomach that things are going to get much, much worse. Again, I could be wrong. 3 years ago, I mean, I didn't anticipate that the Fed was going to print all that money. I figured they'd do some stimulus. I just didn't think you'd increase the money supply by 40%. But hey, is what it is. All right, one last article here. Planned layoffs are up fourfold so far this year. Oh, wait, we skipped one. All right, U.S. debt ceiling deal passes the House with broad bipartisan support. Almost skipped the second article. How rude of me. The U.S. House of Representatives passed a bill to suspend the $31.4 trillion debt ceiling on Wednesday, signaling a bipartisan effort to avoid a catastrophic default. The legislation is supported by both Democrats and Republicans, i.e., when it's bipartisan, the public gets screwed. Was approved by a vote of 314 to 117 and will now proceed to the Senate. The bill must be enacted and sent to President Joe Biden's desk before the Monday deadline when the federal government is projected to run out of funds. Oh, no. The compromise bill reached between Biden and House Speaker Kevin McCarthy faced opposition from 71 hardline Republicans, all of them patriots. However, it received substantial support from 165 Democrats, surpassing the 149 Republicans who voted in favor, ultimately ensuring its passage. The legislation suspends the borrowing limit of the federal government until January 1st, 2025, allowing policymakers to postpone the politically contentious issue until after the 2024 presidential election. Of course, kick the can down the road, deal with it. I mean, do you think Joe's still going to be president? I mean, I'm not, super high on, orange Cheeto boy, but I mean, certainly better than a Democrat. I mean, granted, a empty glass of water is better than anyone who in blue. But anyways, where was I? In addition to the debt ceiling suspension, the bill includes measures such as capping government spending over the next 2 years, expediting permitting processes for certain energy projects, probably green energy, which is crap, reclaiming unused COVID-19 funds, and expanding work requirements for food aid programs. Oh my God, people have to work to get handouts? Hard to believe. Hardline Republicans sought more extensive spending cuts and stricter reforms, while progressive Democrats raised concerns about the bill's work requirement. Oh, you can't can't force lazy people to have to work. I mean, come on. This is going to impact their voting. And its impact on anti-poverty programs. Well, it's not the state's job to handle those things. The Congressional Budget Office estimated that the legislation would result in $1.5 trillion in savings over a decade. Wow, that comes out to $150 billion a year, significantly lower than the $4.8 trillion sought by Republicans and the $3 trillion reduction in deficits proposed by the Biden's budget. The bill reallocates funding from the Internal Revenue Service, although the White House has clarified that it will not undermine tax enforcement. The focus will now shifts to the Senate, where leaders from both parties aim to enact the legislation before the weekend. However, potential delays arising from from amendment votes could complicate the process. Senate Majority Leader Chuck Schumer and Senate Minority Leader Mitch McConnell, two of the people I hate the most in the world, may need to allow votes on Republican amendments to ensure swift action. The Senate debate and voting may extend into the weekend, particularly if any senator seeks to slow down the passage. The debt ceiling impasse has prompted credit rating agencies to issue warnings about possible downgrades of U.S. debt. Rating agencies DBRS, Morningstar placed the United States on review for a potential downgrade, joining similar warnings from Fitch, Moody's, and Scope Ratings. In 2011, during a similar partisan divide with Democrat President, Senate Majority, and Republican Majority House, S&P Global downgraded U.S. debt following a debt ceiling standoff. All right, so we'll see. I mean, I imagine the Senate will probably just push it through because they're a bunch of lazy cowards. I mean, let it fall apart. I mean, that's really the best thing that could happen for us. But hey, what do I know? All right, last one here. Planned layoffs are up fourfold so far this year. That does not sound like good news. According to reports from outplacement firm Challenger Gray & Christmas, companies in the United States have announced an astonishing 417,500 planned layoffs in the first 5 months of 23. The figure represents a significant acceleration, more than 4 times the number of job cuts compared to the previous year. Excluding the early months of 2020 when COVID-19 pandemic impacted the labor market, this year's total is the highest since 2009. And remember what happened back then? The tech industry saw the largest number of job cuts with 136,800 announced in the first 5 months of the year. This figure came close to surpassing the full year total of 168,400 in 2001 when the tech industry experienced significant layoffs. The impact of job cuts is now spreading to other sectors, including banking, retail, and media. The media industry has announced 17,400 in job cuts so far this year, while the banking sector has seen a surge in layoffs, with financial firms announcing 37,000 job cuts through May, more than 4 times the number compared to the previous year. The aggressive interest rate hikes implemented by the Federal Reserve over the past 14 months have prompted companies to tighten their budgets and control costs. Many firms have enacted hiring freezes due to mounting macroeconomic headwinds and the increasing risk of a slowdown later in the year. The data from Challenger indicates that layoffs have risen 287% year on year, suggesting that large-scale job cuts are likely to continue. Furthermore, the report highlights the impact of artificial intelligence on job losses. Approximately 3,900 jobs have been lost to AI, and this number is expected to increase significantly. A recent Goldman Sachs report estimated that tens of millions of jobs could be lost in the coming years due to AI. Yeah, they'll just go do something else. Job recruiters have cautioned that the cycle of tech layoffs is not yet complete, indicating that further job cuts may be on the horizon. The combination of economic factors, technology advancements, and the evolving business landscape continues to pose challenges for companies, leading to significant workforce reductions. The surge in planned job cuts across industries underscores the ongoing labor market challenges and the need for individuals and businesses to adapt to changing conditions. The effects of these layoffs will be felt by both workers affected and the broader economy as companies navigate the evolving landscape and make strategic decisions to remain competitive. And you can see here on this chart right here, 364,000 was the total layoffs all of last year. And then this black box is 418,000 just through May. So again, the bad news is accelerating. So I imagine by the time we hit mid-year in a month or so, and then it's just going to be downhill probably from there. So, but again, who knows? Things could turn around completely, and I could be completely off. I mean, Jim Cramer seems to think things are fine, and that's always a sign that things are going to turn around. Anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.